You say you know NAV. Fine, then answer these. A mutual fund NAV is wrong 15 minutes before sign off. Where do you look first? A hedge fund has a broker mark and an internal model mark that do not agree. Which one would you challenge? A private equity investment has not been sold, no cash came in. Why did the fund's NAV rise? A private credit borrower paid no cash interest. Why did NAV still move? And a property is worth $60 million. Does that mean the real estate fund's NAV is 60 million? If your answer to all five begins and ends with a formula, you know the formula, you do not yet know NAV. Before we go further, one point that fund accountants have to get right. On a balance sheet, assets are matched by liabilities plus the residual attributable to investors. So when we say fund NAV is assets minus liabilities, we are not subtracting the entire right hand side of the balance sheet. For the NAV calculation, we deduct the fund's external obligations, things like payables, accrued expenses, borrowings, and other amounts owed outside the fund. What remains is the fund's net assets. And if the fund is unitized, NAV per unit is that net asset amount divided by the units outstanding. Same idea for NAV per share. That distinction matters because total fund NAV and NAV per unit are not the same number. Now the harder part. Cash movement does not automatically mean NAV movement. An investor can subscribe and cash can rise without the fund earning anything. Cash can leave to buy an investment without making the fund poorer. And NAV can move even when no cash moves at all. Second trap. NAV movement is not automatically performance. Capital activity can change total fund NAV without creating investment return. Third trap. More shares, more units, or more assets do not automatically mean more economic value. You have to understand what changed on the other side. The formula is the easy part. What sits behind NAV is where the real work begins. Now put yourself into a mutual fund close. It is late in the day and the NAV you're reviewing is not where you expected it to be. Where do you start? Prices? Good, but that is only the beginning. I would check the closing prices and their dates, then foreign exchange, then dividend and interest accruals, then expenses, then corporate actions, then subscriptions and redemptions, and finally whether the units outstanding reconcile. Now imagine one security has barely traded. Yesterday's price is still sitting in the system. There is a number on the screen. Does that make the price right? No. I want to know the source, the as of date, whether the price is stale, and whether the valuation policy requires an escalation. A populated price field is not the same thing as valuation evidence. Now suppose prices reconcile, cash reconciles, but the NAV is still off. You keep digging and find the break. A dividend entitlement was never accrued. One missed event explains the difference. That is why I become careful when someone says mutual fund NAV is simply price times quantity. Finding a number is easy. Proving that the number belongs in NAV is the real work. Now make the portfolio harder to price. You're reviewing a hedge fund. One over-the-counter derivative is valued at $12.4 million by the internal model. The broker mark says 11.8. Which one goes into NAV? Use the broker is not enough. Neither is use the model. I would first ask what the valuation policy says. What is the approved price source hierarchy? What inputs went into the model? Was there independent price verification? And why is there a $600,000 difference? Because with hedge fund NAV, the question is sometimes not what is the price, it is where did that price come from and can you defend it? Now add a short position. The long book made money, but the short moved against the fund and financing costs accrued. Can NAV still disappoint? Absolutely. You have to follow the short exposure, derivative profit and loss, security borrow costs, financing and fund expenses. Then comes an illiquid position. Would you support that valuation with exactly the same evidence as a listed equity? Of course not. Liquidity changes the evidence you need and the valuation process you follow. Now remove the quoted market price almost completely. The company has not been sold, no exit happened, no cash came in, but the fund's NAV increased materially. Now we are in private equity. Start with a capital call. Investors contribute $20 million. Cash arrives and total fund NAV increases. Did the fund just earn $20 million? No. That is investor capital, not investment performance. Now the fund uses $15 million of that cash to buy an investment. Cash leaves the bank. Did total fund NAV fall by 15 million? No again. One asset became another. Cash became an investment. Now the interesting part. That investment was originally carried at $15 million. At quarter end, its fair value is 21 million. No sale happened. No cash was received. Can NAV rise by $6 million? Yes. But now the real review starts. Why is the investment worth 21 million? Did the portfolio company's earnings improve? Did comparable company multiples move? Is there new transaction evidence? Is a discounted cash flow being used? Which assumptions changed? This is where experienced reviewers know the real argument can begin. Two accountants can agree on every journal entry and still disagree with NAV because the disagreement may be valuation, not accounting. Now let three things happen. Fair value rises, a management fee accrues, later the fund makes a distribution. Three events, three different NAV stories. The fair value uplift is performance. The management fee is an expense and reduces NAV. The distribution reduces cash and may reduce investor capital because money has left the fund. But a distribution does not mean the portfolio suddenly made a loss. That distinction matters because private equity NAV can move because of valuation, expenses, capital activity, distributions, and allocations. Those movements do not mean the same thing. Now replace the equity investment with a loan. The borrower paid no cash interest this month, but the private credit fund recognized income. How? Because earning income and receiving cash are not always the same event. Interest can accrue before cash arrives. Payment in kind interest can increase the loan balance instead of arriving in the bank account. Now suppose the loan was issued below par. Part of that original issue discount may accrete over time. Can NAV move even though there was no new cash transaction today? Yes, but here is the more important private credit question. The borrower is still making its scheduled payments. Nothing has defaulted, but the business has deteriorated badly. Can NAV fall? Potentially yes, depending on the valuation and accounting basis. Because income earned and credit risk are not the same thing. A private credit investment can continue generating income while the credit story is moving in the opposite direction. That is the trap. Now replace the loan with a building. A real estate fund owns an office property valued at $60 million. Is the fund's NAV 60 million? No. The property value is only one asset inside the fund. Suppose there is $25 million of debt. There may also be cash, receivables, payables, accrued interest, operating expenses, and other fund level assets and external liabilities. So you still have to move from the gross property value to the net assets attributable to investors. Now suppose the property valuation rises by $4 million during the period. Rental and other operating economics add 2 million. Interest and financing costs reduce value by 1 million. The building itself increased by 4 million. So why did fund NAV move by 5? Because real estate NAV is not only a property value story. It is a property, operating and financing story. And be careful with capital expenditure as well. Cash may leave to improve the property. That does not automatically mean NAV falls by the same amount. By now we have moved through mutual funds, hedge funds, private equity, private credit and real estate. Different assets, different valuation evidence, different income patterns, different capital structures. But one accounting distinction has stayed constant. At fund level, NAV is the residual after deducting the fund's external obligations from its assets. If the vehicle has shares or units, NAV per share or per unit is that residual divided by the shares or units outstanding. That is why I never mix up total fund NAV with NAV per unit. And when NAV does not tie, I do not use 5 completely different review processes. I start with the same sequence every time. NAV does not tie. Where do you look? I start with cash. Does bank or custodian cash reconcile? Is there unsettled activity not captured? Then positions. Are the quantities correct? Is a trade missing? Was a corporate action processed incorrectly? Then prices and valuation. Is the price wrong or stale? Is the model wrong? Did a valuation assumption change? Then foreign exchange. Was the correct rate and date used? Is the exposure in the right currency? Then income. Was a dividend missed? Did interest accrue? Was payment in kind income recorded? Was rental income captured? Then expenses, management fees, financing costs, operating expenses. Is an accrual missing, duplicated, or in the wrong period? Then investor capital, subscriptions, redemptions, capital calls, distributions. And keep reminding yourself, capital movement is not the same thing as performance. Finally, timing, a late trade, a reclassification, a true up, a backdated event. Something booked after the first calculation can completely change the NAV bridge. That is the sequence I want in my head when NAV does not tie. Not because every fund is identical, but because it stops me jumping randomly from number to number. Now look again at the 5 fund types. In a mutual fund, the dominant NAV questions are often prices, foreign exchange, accruals, corporate actions, investor flows, and units. In a hedge fund, I add pricing sources, derivatives, models, short exposure, financing, and illiquid positions. In private equity, I care about fair value, capital activity, fees, distributions, and whether performance is realized or unrealized. In private credit, I separate income accrual from cash receipt, then ask what happened to valuation and credit risk. And in real estate, I connect property valuation with operating economics, debt, financing, and other fund level liabilities. The basic logic is the same. Start with the assets. Deduct the fund's external liabilities and obligations. What remains is total fund NAV. If the structure is unitized, divide that net asset amount by the units outstanding to get NAV per unit. If it is share based, divide by the shares outstanding to get NAV per share. That distinction matters because assets minus liabilities divided by units describes NAV per unit, not total fund NAV. And saying assets equal liabilities, so NAV must be 0, mixes up external liabilities with the investor residual on the other side of the balance sheet. So before I explain NAV, I ask 6 things. What exactly was valued? How was it valued? What was earned? What reduced value? What came from investor capital rather than performance? And can I reconcile opening NAV to closing NAV? If I can answer those 6 questions, I am not just calculating NAV, I am explaining it. Now imagine an interviewer asks, explain NAV. A weak answer is assets minus liabilities. It is incomplete because I still want to know what you mean by liabilities, whether you are talking about total fund NAV or NAV per unit, and how you would defend the number. A stronger answer would sound like this. Total fund NAV is the residual value attributable to investors after deducting the fund's external liabilities and obligations from its assets. If the fund is unitized, NAV per unit is that net asset amount divided by the units outstanding. Then, to explain why NAV moved, I would analyze valuation, income, expenses, capital activity, and the bridge from opening NAV to closing NAV. Then I would tailor the review to the fund. For a mutual fund, I would focus on prices, foreign exchange, accruals, subscriptions and redemptions, corporate actions, and units outstanding. For a hedge fund, I would also challenge pricing sources, derivative marks, financing, short positions, and less liquid assets. For private equity, I would focus on fair value, capital activity, fees, distributions, and realized versus unrealized performance. For private credit, I would separate accrued income from cash received, then analyze valuation and credit risk. And for real estate, I would connect property valuation with rental and operating economics, debt, financing, and other fund level assets and liabilities. That answer sounds different because the person giving it is thinking like someone who may actually have to prepare NAV, review it, challenge it, explain it to a client, or defend it in an interview. So when somebody tells me I know NAV, my next question is, which type of fund have you worked with? And can you explain what actually moved the NAV? If you work in mutual funds, hedge funds, private equity, private credit, or real estate, tell me which world you work in. And if this is how you want fund accounting explained through situations people actually face at work and in interviews, subscribe to the Fund Desk. We do not stop at the number, we follow what moved the NAV.